In this presentation, we will discuss examples of data from California's Cap-and-Trade program and how it can be used, and will also provide an overview of all of the information that is made publicly available related to this program. The purpose of this presentation is to ensure that market participants and other interested parties understand the types of data that CARB publishes related to the Cap-and-Trade program, where this information can be found, and how it can be used to better understand the linked California and Quebec carbon market. We start by responding to several general questions about the program, market data, and underlying greenhouse gas emissions data. Then, we'll take a closer look at the program and provide a general overview of each major aspect of the operations of the program, from allocation to auctions to offset issuance and compliance. Closed captioning is available by clicking the CC button on the right side of the video player menu. CARB provides a wide range of information to the public on every aspect of the Cap-and-Trade program. Publication of this data supports the operation of the program and ensures transparency. Regular posting of program data also supports efficiency in the market. CARB policies require that programs comply with all state and federal regulations that address the maintenance, security, and disclosure of personal and confidential business information and the protection of privacy. CARB provides many reports on a regular schedule to ensure all market participants have access to the same information at the same time in order to avoid data asymmetry. Information about the program that is not published on a regular schedule is released with advance notice to market participants. In cases where such information includes market-related information with Quebec, our linked partner jurisdiction, the notice of information and publication release date and time are closely coordinated to avoid data asymmetry. CARB program staff adheres to strict procedures concerning confidentiality and market sensitivity. CARB does not comment on third-party analyses or opine on market activities, nor does CARB disclose confidential business or personally identifiable information that is protected pursuant to the California Public Records Act and the Information Practices Act. Further, CARB has extensive policies on data release because of the market design of the program and identifies and handles market-sensitive data in a uniform and transparent format. The advanced notifications mentioned previously identify specific posting dates and times to ensure simultaneous and equal access to all market participants and the public. For instance, advance notices are provided for auction supply, requirements for participation, auction results, and proceeds. Slides 23 and 24 of this presentation provide a detailed schedule for the release of market information and reports. This slide provides the outline of the presentation, which is divided into two major sections and includes links to 4 video modules that will be played during this recorded presentation. The video modules can also be accessed separately and independent of this presentation on the Cap-and-Trade Program Data webpage. Links and contact information are also provided at the end of this presentation on the resources slide. The first section of this presentation focuses on how publicly available program data can be used to understand major cap-and-trade program concepts, from calculating compliance obligations, tracking allowance disposition over time, understanding industrial allocation and covered emissions, and estimating the value of the compliance offset program. This first section addresses commonly asked questions about the cap-and-trade program. It assumes that the viewer has a basic understanding of the cap-and-trade program requirements and provisions. The second section of this presentation provides a general overview of the Cap-and-Trade program. This part of the presentation introduces available price data sources and allowance allocation for industrial sectors, electrical distribution utilities, and natural gas suppliers. It provides a walkthrough of auction data reports and how to find past auction results and statistics, an overview of the compliance offset program, and finally, a summary of program compliance and enforcement information that is publicly available. This is the first section of the presentation, using publicly available data. In this section, we will explain specific examples of how the cap-and-trade program data can be used to answer commonly asked questions about the program. The whole presentation is approximately 2 hours long with 4 video modules included. Video Module 1 is Understanding Compliance Obligations. Video Module 2 is the Compliance Instrument Report. Video Module 3 is Understanding Industrial Allocation. Finally, Video Module 4 is Auction Data. For those viewers who would like a general overview of the program and an introduction to the various program requirements and provisions before discussing specific examples, please watch Section 2 of the presentation first and then return to Section 1 later. This presentation will cover 4 particular examples that respond to common questions CARB staff receive. The 4 examples are listed here. 1. Understanding compliance obligations. 2. Tracking allowance disposition over time. 3. Understanding industrial allocation. And 4. Estimating value of the compliance offset program. These examples are discussed in detail with the assumption the viewer has an understanding of the program topic and requirements. As mentioned on the previous slide, if it would be helpful to review an overview of the program requirements and provisions first, skip to Section 2 beginning with Slide 22. Pursuant to the California Global Warming Solutions Act of 2006, CARB developed an annual greenhouse gas (GHG) reporting regulation which was approved in 2007. This mandatory reporting regulation, or MRR, collects data from the largest GHG emitters and supports several other CARB programs, including the Cap and Trade Program, the AB 32 Cost of Implementation Fee Regulation, and the statewide greenhouse gas emissions inventory. In general, MRR requires industrial sources, fuel suppliers, and electricity importers to report their annual GHG emissions. In addition to mandatory reporting of emissions data, MRR requires reporting of product data, the independent verification of emissions data reports, and CARB accreditation and oversight of verification bodies consistent with international best practices. Only CARB accredited verification bodies may provide verification services to reporting entities. The MRR program requires annual reporting of GHGs from industrial sources that emit more than 10,000 metric tons of carbon dioxide equivalent or CO2e from transportation and natural gas fuel suppliers and from imported electricity. If the greenhouse gas emissions for a facility or fuel supplier exceed 25,000 metric tons of CO2e per year, or an electric power entity reports any covered emissions above zero, the reported data must also be verified by a CARB-accredited third-party verification body. Since 2010, reporting entities have been required to have their GHG emissions data reports verified each year by a CARB-accredited verification body. Beginning with 2017 data verified in 2018, the verification deadline is August 10th. This slide provides links to useful tools and data reports. The annual data collected by MRR is provided in a summary spreadsheet that is typically released in the beginning of November. This summary spreadsheet, which is called the Annual MRR GHG Facility and Entity Emissions Report, or GHG Emissions Data Report for short, includes the results of the third-party verification for emissions data and for product data, which are referred to as the verification statement. Because of regulation changes that became effective after January 1, 2012, reports for 2011 data and onward will have differences from the historical 2008 to 2010 data because of changes in the reporting requirements. Entity-specific product data that is required to be reported for specific industrial sectors is not made publicly available in the annual MRR report because it contains confidential business information that cannot be publicly released. However, the verification statement for the product data is included in the report to indicate if the submitted product data were complete and accurate. Finally, the data summarized in the annual MRR GHG Facility and Entity Emissions Report reflects all facilities and entities subject to MRR and does not include all California GHG emissions sources such as emissions from land use change, agriculture, or certain other sources. A full list of sources that are required to report pursuant to MRR is available in the MRR regulation. The CARB Pollution Mapping Tool is an interactive map that allows users to locate and view emissions of greenhouse gases, GHG, and criteria pollutants from large facilities in California. The map includes emissions data for toxic air pollutants along with criteria pollutants and greenhouse gases from large facilities in California. Users can select facilities by a number of attributes such as name, location, or industrial sector using Google Earth and satellite mode imaging. Users can also view their reported emissions using maps, charts, and tabular formats, and download data for later use. CARB's Pollution Mapping Tool was updated on June 18, 2019, and is typically updated each year to reflect the prior year's verified GHG emissions data. The next resource link for the MRR program is CARB's verification webpage. Two primary components of the MRR verification requirements are an accreditation program for GHG verification bodies and individual verifiers, and a verifier performance oversight program. Only CARB-accredited verifiers can provide verification services for reporting entities subject to mandatory reporting. Verifiers are subject to specific requirements that include pre-screening for education and professional experience, CARB-developed training, and the successful passage of a CARB verification exam. Once these steps are met, CARB issues an executive order for CARB accredited verifiers that is valid for a period of 3 years, whereby the applicant may reapply for accreditation. A list of accredited verifiers and executive order copies may be found on the CARB verification webpage. Finally, note that the MRR data is a subset of the statewide GHG emission sources, capturing approximately 80% of the GHG emissions included in the state's GHG emissions inventory. The statewide GHG emissions inventory is a different and separate program from MRR that establishes historical emission trends and is an important tool for tracking California's progress in reducing GHGs. CARB also publishes a report of all entities that are registered in the Cap and Trade Program online registry and instrument tracking system called the Compliance Instrument Tracking System Service, or CITSS. Entities involved in the Cap and Trade Program must register for accounts within the CITSS system. These CITSS accounts allow an entity to manage and track their account balance of compliance instruments, coordinate with corporate associated entities on the division of purchase and holding limit shares, and apply for quarterly joint auctions. Market participants must register through CITSS in order to hold, trade, and retire compliance instruments. The most current CITSS registrant report is accessible from the publicly available market information section of the Cap and Trade Program webpage. The CITSS registrant report is updated on the last business day of each calendar quarter based on data pulled from CITSS at noon on the business day prior to the release of the report. For the June 2019 report, the report was released June 28, 2019, and reflects any CITSS account changes as of noon on June 27, 2019. Note that account changes may still be in progress, such as facility retirements from changes of facility ownership and entities converting to a voluntary participation status or exiting the Cap and Trade Program. Any changes reflected in the CITSS registrant report must have been processed in CITSS by the time the data is pulled to generate the quarterly registrant report. CITSS accounts for registered entities are displayed in the CITSS registrants report in numerical and then alphabetical order, with the first entity listed in the June 2019 report as Three Phases Renewables Inc., CA 1763, and the last entity in that report listed as Zuber Farms LLC, CA 2034. The ID number in the second column will all start with CA for those entities registered in California. In the third column, the report includes the entity type, which helps to identify those entities that likely have an upcoming compliance obligation and an interest in acquiring compliance instruments. There are a total of 4 entity types in CITSS. 1. Covered entity, covered source, or opt-in entity. 2. General market participant, previously covered. 3. General market participant, organization. And 4. General market participant, individual. These are referred to in the regulation as a covered entity, an opt-in entity, and a voluntarily associated entity. See Subarticle 3 of the regulation for complete requirements. The fourth and final column of the report identifies the mandatory reporting GHG ID and multiple IDs assigned to an entity with one or more covered emission sources that are subject to the Cap and Trade Program. For the entity type, covered entity, covered source, or opt-in entity, a GHG ID will be identified. For entities that do not have a compliance obligation and are voluntarily associated entities in the program, these can be observed with a NA or not applicable noted in the column. As of June 2019's CITSS registrant report, there were approximately 700 registered entities, with almost half of these registered with an entity type of covered entity, covered source, or opt-in entity. This report is a useful resource that provides market transparency on the level of participation at the industry, company, and individual level. The report can be used to track market participation from the total number of covered entities, their covered emissions reported to the Mandatory Reporting Regulation, MRR, and the obligation requirements due to cap and trade to the total number of voluntary market participants that include offset project operators, consultants, brokers, traders, investment firms, and individuals. In order to calculate what an entity's compliance obligation is under the Cap and Trade Program, as well as the number of compliance instruments the entity must acquire and surrender to CARB based on its reported and verified covered emissions, it is helpful to understand the following concepts: total covered emissions, compliance requirements, the difference between an annual or full compliance period compliance obligation deadline, and the total compliance instruments surrendered by the entity to date. The first compliance period included the total covered emissions from 2013 and 2014 subject to a compliance obligation. There were two separate compliance deadlines in this first compliance period, which is also referred to as CP1. Pursuant to the Cap and Trade Regulation, the compliance deadline is the first business day of November. For CP1, the deadlines were November 3, 2014, an annual compliance obligation deadline, which required entities to surrender compliance instruments equal to 30% of 2013 covered emissions, and November 2, 2015, the full compliance obligation deadline of this compliance period, where entities were required to surrender compliance instruments equal to the remaining 70% of 2013 covered emissions and 100% of 2014 covered emissions. For both of these compliance events, CARB has published compliance summary reports that show each entity's compliance status and the total number and type of compliance instruments surrendered for that compliance event. For the first annual compliance obligation deadline, entities surrendered 100% of their obligation due, and for the full compliance period compliance obligation due on November 2, 2015 for CP1, entities surrendered 99.99% of their total 2013 to 2014 triennial surrender obligation. Any differences between total covered emissions and total compliance obligations can be associated to late compliance or non-compliance, changes of ownership, late entrants that are eligible to defer their obligation to the next compliance period, or underreported emissions. The next slide will discuss the second compliance period and include a video module of how to track an entity's covered emissions and their estimated compliance obligation. The video will also illustrate an example of how to use multiple emissions data reports to understand an entity's compliance obligation. The second compliance period included covered emissions from 2015, 2016, and 2017. Covered emissions, as explained previously, are those emissions that are subject to compliance obligation under the Cap and Trade Program. Additionally, some entities that were new entrants to the Cap and Trade Program per Section 95853D of the regulation may have deferred their 2014 covered emissions to the second compliance period. This means some entities had larger compliance obligations to surrender on November 1, 2018 that included 100% of their 2014 covered emissions on top of the 2015 to 2017 remaining emissions obligations due. The three deadlines in this second compliance period were November 1, 2016 annual compliance obligation deadline, where an entity was required to surrender compliance instruments equal to 30% of its total 2015 covered emissions, November 1, 2017, annual compliance obligation deadline, where an entity was required to surrender compliance instruments equal to 30% of its total 2016 covered emissions, and finally, the November 1, 2018, full compliance period compliance obligation deadline, where an entity surrendered compliance instruments equal to its remaining 70% of 2015 covered emissions, 70% of 2016 covered emissions, and 100% of 2017 covered emissions. Video Module 1, Understanding Compliance Obligations, will now walk through an example calculation for a covered entity with two facilities. Welcome to Video Module 1, Understanding Compliance Obligations. The video module is also available to watch on CARB's Cap and Trade Program Data website at www.arb.ca.gov/cap-and-trade-program-data. In this video, we'll explain how to calculate an entity's compliance obligation using the annual mandatory reporting regulations, emissions data reports. On this data webpage, you can access various reports on compliance, allocation, registration, holdings, transfer summaries, other market data, as well as the links to this presentation and 4 separate video modules. There is a summary report available for each compliance event that is made publicly available in December following the November 1st compliance deadline. The report identifies every entity that was assessed a compliance obligation and provides details on the amount and types of compliance instruments used to meet that obligation. For this video, we'll focus on the 2015 to 2017 compliance report. Here is a summary report for the second full compliance period for 2015 to 2017 covered emissions. There are 5 tabs in this report. The first 2 tabs provide an overview of the report and the column and/or cell descriptions and notes. The Introduction tab for this report explains that this is a full compliance period compliance obligation, which is equal to the sum of 100% of the covered emissions verified for the 2015, 2016, and 2017 emission data years. The third tab is the overall compliance summary, identifying every covered and opt-in covered entity that was assessed a compliance obligation due to covered emissions above the threshold. The last two tabs of the report show details of the vintages and types of allowances and offset credits that were surrendered. The allowance details identify the total number of vintages 2013 to 2019 allowances that were surrendered by each entity on November 1st, 2018. Offset details are also listed for each entity and include the vintage, quantity, and ARB offset project ID number. Going back to the third tab, or the 2015 to 2017 compliance summary, the CITSS entity ID in the first column shows the account number assigned to each registered entity. Each entity will have at least one registered facility or covered source, and some entity accounts and kits may have multiple facilities that are registered to it. This is what we call a consolidated entity account. The facilities or entities' covered emissions that are used to calculate the compliance obligation can be tracked or confirmed by using the ARB greenhouse gas ID and looking at the annual emission reports on the Mandatory Reporting Program webpage. Here, we can access the annual data collected by mandatory reporting. This data is provided in a summary spreadsheet that is typically released in the beginning of November. The summary spreadsheet is called the Annual MRR GHG Facility and Entity Emissions Report, or GHG Emissions Data Report for short, and includes the results of the third-party verification for emissions data and for product data, which are referred to as the verification statement. All historical emissions data reports are available to access on the Mandatory Greenhouse Gas Reporting Reported Emissions webpage. For this video module, let's take a look at the 2017 GHG Facility and Entity Emissions Report as an example. The report has three tabs: an introduction, which provides an overview of the included data, a columns description, which provides a description of each data column of the data tab, and finally, the actual data tab, which is the 2017 greenhouse gas data, showing a summary of annual emissions data reported under the California Greenhouse Gas Mandatory Reporting Regulation. The first column of the report shows each facility or each entity with reported emissions. The ARB ID, or Greenhouse Gas Reporting ID number, identifies a specific facility or entity. This number is used to track covered emissions subject to a cap-and-trade compliance obligation. The total emissions subject to a compliance obligation in the cap-and-trade program are shown in the Total Covered Emissions column R. Total covered emissions column R in the spreadsheet can be calculated as the value equal to the total emissions shown in column F minus the non-covered emissions shown in column S. The non-covered emissions include emissions that are exempt from a compliance obligation under the cap-and-trade program, such as biogenic emissions from exempt biomass fuels and certain fugitive emissions. Let's go back to the 2015 to 2017 compliance report. Row 14 shows entity ID CA1019, which has two facilities associated with it that are identified as ARB GHG IDs 101701 and 101749. This means that the entity has two facilities or covered emission sources registered to its account. If an entity has multiple ARB GHG IDs listed, in other words, this entity owned or operated multiple facilities or emission sources, we would need to look at each of the GHG IDs and their respective annual emissions to calculate the total covered emissions for this compliance period. Let's look at the 2015, 2016, and 2017 annual emissions data reports as reference to calculate the entity's compliance obligation. On the MRR program website or Reported Emissions Data webpage, we can find all historical emissions data reports. For this example, we've gone ahead and downloaded the 2017 emissions data report as well as the 2016 and 2015 emissions data reports to calculate the total 2015 to 2017 full compliance obligation for CA 1019. It is important to note the greenhouse gas IDs assigned for CA 1019. First, we'll search each of the annual data reports for the first facility registered to CA 1019, which is GHG ID 101701. You cannot search the greenhouse gas reports with the CITSS ID number, as that CITSS ID number is specific to the Cap and Trade program. For 101701 shown in this report, we'll find that the 2017 covered emissions in column R shows as 629,938 metric tons of carbon dioxide equivalent. It's important to remember to search for covered emissions in these data workbooks by looking up column R. We'll now do the same search in the 2016 and 2015 emission data reports. The 2016 data report shows the total as 644,287. Finally, the 2015 data report shows the total as 552,487 metric tons of carbon dioxide equivalent. This entity, CA 1019, has two registered greenhouse gas IDs or facilities. The second ID is 101749. For simplicity of this example, we pulled these values into a table here for reference. Here, we calculated the sum of total 2015 to 2017 covered emissions for each facility or greenhouse gas ID. The sum for both of these greenhouse gas IDs is 4,258,874 covered greenhouse gas emissions subject to a compliance obligation. In the 2015 to 2017 compliance summary report, we can see that CA 1019 was assessed an obligation equal to its total covered emissions. This obligation was 4,258,874. The entity obligation status shows as fulfilled, which means the entity surrendered an equal amount of compliance instruments as the total covered emissions calculated for that period. Here, the entity surrendered 3,918,165 allowances and 340,709 offset credits to fulfill their compliance obligation for both greenhouse gas IDs or facilities. There are a few considerations to recognize when reviewing this compliance summary report. First, CITSS calculates the obligation for an annual or full compliance period compliance obligation by simply displaying the sum of verified covered emissions. Using CA 1019 as an example, let's look at the 2015 compliance report. The 2015 compliance report reflects the first annual deadline of the full compliance period from 2015 to 2017. Here, we'll see that the obligation is calculated as 30% of the total 2015 emissions obligation value of 1,372,373. For CA 1019, we can confirm that this obligation is equal to its total covered emissions for calendar year 2015 by looking at our reference workbook. The 2015 compliance summary report shows the entity status as fulfilled. This means the entity surrendered 30% of its obligation due for that year. When calculating compliance obligations, it is important to recognize that the most recent available emissions report may not be available to use as reference until after the compliance deadline. On the mandatory greenhouse gas reporting reported emissions data webpage, these reports are typically posted the first week of November following the compliance deadline. However, an entity will have already known its annual emissions as they would have submitted emissions data by the applicable April 10th or June 1st reporting deadline and obtain verification of their supported emissions data reports by August 10th or the first business day thereafter if August 10th is a weekend or holiday. Finally, when reviewing compliance summary reports, it's important to note that for most entities, the total covered emissions generated during a compliance period will equal to the total compliance instruments surrendered. However, changes to facility ownership, deferred emissions, bankruptcy, or noncompliance may result in a difference between the verified aggregated entity-level emissions and entity's total obligation and the total instruments surrendered. Additional footnotes are provided on the Compliance Summary tab here for reference. For the second compliance period that covered 2015 to 2017 greenhouse gas emissions, 99.62% of the full compliance period compliance obligation was fulfilled, where entities surrendered 981,442,093 compliance instruments. An entity that does not meet the compliance deadline for surrendering its annual or full compliance period compliance obligation is subject to a 4-to-1 compliance obligation for untimely surrender. The untimely surrender obligation is any unfulfilled portion of an entity's annual or full compliance period compliance obligation and is calculated as 4 times the entity's outstanding emissions. Entities may use both current and future vintage allowances for 3/4 of the untimely surrender obligation, and up to 1/4 of the obligation may be met by surrendering offset credits. If an entity does not comply with an untimely surrender obligation, CARB may take additional enforcement action and penalties may be assessed for any violation of this regulation. This now concludes Video Module 1 on Understanding Compliance Obligations.
Now that we have covered how to determine an entity's compliance obligation, let's look at allowance supply. The California Cap-and-Trade Program issues a fixed number of allowances that entities are given through the allocation process, or the CARB auctions. We will discuss allowance allocation and auctions later in this presentation. The program is designed with decreasing annual caps, or allowance budgets, so the total quantity of allowances available decreases over time. The decreasing annual budgets help to ensure that the state will meet its mandated greenhouse gas emission targets, reducing emissions to 1990 levels by 2020 and achieving a 40% reduction below 1990 levels by 2030, while ensuring progress to longer-term goals of 80% below 1990 levels by 2050 and carbon neutrality. California's Cap-and-Trade Program linked with Quebec's Cap-and-Trade system on January 1, 2014. Linkage allows for the use of compliance instruments from Quebec's Cap-and-Trade system. Therefore, the California allowance budget and Quebec allowance budget together establish the total allowance supply in the joint carbon market. Each jurisdiction designated a small percentage of allowances from their budgets to be placed in price containment reserves. A covered entity may purchase allowances for compliance from its jurisdiction's reserve account at a predefined price. Cost containment is needed to minimize price volatility and provide market stability in the case of strong surges in short-term demand to meet immediate compliance needs. Reserve sales are only held if an entity indicates they want one. To date, that has not happened. The allowances placed into the APCR are not in the general market and are only accessible for direct compliance by covered entities. Tables 6.1 and 6.2 in Subarticle 6 of the regulation define the California annual allowance budgets. Subarticle 8 of the regulation covers disposition of allowances within the budget, that is, how allowances are allotted to various uses and distributed to the market.
This slide shows a screenshot of the 2019 Quarter 2 tab from the Joint California and Quebec Compliance Instrument Report. As explained further in Slide 13 and Video Module 2, this is a joint report produced by California and Quebec, and the data is pulled from CITSS, typically by the 3rd business day of each calendar quarter. This report shows the number of instruments aggregated by instrument type, account type, and vintage. The report identifies the total amount of allowances and offset credits held by entities and the amount held by all participating jurisdictions, which currently are California and Quebec. Video Module 2 provides a closer look at this report. Throughout a compliance period, entities accumulate allowances for compliance through several means, including through auctions, transfers between entities, and some entities receiving free allocation. Offset credits are acquired through private transactions between registered market participants bilaterally or on what is typically referred to as the secondary market. CARB, in coordination with Quebec, publishes a quarterly compliance instrument report that provides a snapshot of where all compliance instruments, allowances, and offset credits are within CITSS. This joint report provides an accounting of all allowances and offset credits issued to date in the linked market. The aggregated data reveals allowance holdings in private entity and jurisdiction accounts by account type. It is important to recognize that the Compliance Instrument Report shows combined data from both California and Quebec's entity and jurisdiction accounts in the linked carbon market. The aggregated data ensures that confidential business information such as entity and sector-based product data, compliance strategies, or market-sensitive information remains protected. The Compliance Instrument Report provides a high-level overview and transparency on the compliance instruments currently in market circulation while still ensuring proper handling and safeguarding of the market-sensitive data. Video Module 2 includes a brief walkthrough of this quarterly Compliance Instrument Report and identifies the different accounts and kits by entity and by jurisdiction. In the video, we will discuss the retirement of allowances and the changes one can see in the disposition of holdings and supply over time. Most notably, entity account balances drop significantly at the end of a compliance period when entities must surrender allowances from their kits accounts to their jurisdiction retirement accounts. The video will cover each entity and jurisdiction account as well as the designated use allowances in the California Voluntary Renewable Electricity Reserve account and in Quebec's Environmental Integrity Jurisdiction account. Finally, the video in the next few slides will explain how the data in the Compliance Instrument Report can be used to understand and track the quantity of compliance instruments in circulation, among other market trends. Welcome to the Compliance Instrument Report Video Module 2. This video will explain the report in detail, including each of the entity and jurisdiction accounts. The video module is also available to watch on CARB's Cap and Trade website at www.arb.ca.gov/cap-and-trade-program-data. On this data webpage, you can access various reports on compliance, allocation, registration, holdings, transfer summaries, other market data, as well as links to this presentation and 4 separate video modules. We'll now focus on the Compliance Instrument Report for this video. This report breaks out the disposition of allowances and offset credits into 2 main account categories: entity accounts and jurisdiction accounts. Allowances are identified by vintage year and type, including the non-vintage Quebec Early Action Allowances and non-vintage Price Containment Reserve Allowances offered by the jurisdictions. Offset credits are identified by project and by the jurisdiction issuing the credits. As of Q2 2019, 4 of California's 6 approved compliance offset protocols have resulted in the issuance of California carbon offset credits to date. Offset credits can only happen in sectors that are not covered by the cap, meaning they must come from sources that are outside of the industrial, energy, and transportation sectors. The quantification methodologies in the offset protocols ensure credits are real, quantifiable, permanent, enforceable, verifiable, and additional. Additional means that offsets must come from greenhouse gas reductions from uncapped sectors that exceed any greenhouse gas reduction or removals otherwise required by law, regulation, or a legally binding mandate, and that exceed any greenhouse gas reductions or removals that would otherwise occur in a conservative business-as-usual scenario. Once allowances and offset credits are surrendered by an entity to CARB or Quebec, they are placed into the appropriate jurisdiction's retirement account. Once they are in the retirement account, whether as part of a voluntary retirement or to satisfy a compliance obligation, they are considered to be immediately out of market circulation and cannot be reintroduced. The compliance instruments that are in each jurisdiction's retirement account are each equal to 1 metric ton of carbon dioxide equivalent emissions. We'll now walk through the different entity and jurisdiction account types now that we've explained the different types of compliance instruments. Entity accounts are broken into 3 types: general holding account, compliance account, and limited use holding account. The instruments reflected in an entity's general holding account indicate that the entity is holding on to those allowances or offset credits currently for the time being, and the entity will then choose to trade those instruments with another market participant or surrender them for compliance. Entities that have compliance instruments in their compliance account have designated those instruments for compliance use only. Entities cannot move those instruments out of their compliance accounts, as California or Quebec will retire the appropriate amount for each compliance event. Allowances and offset credits in entities' compliance accounts are considered to not be available for trading. There are certain limited exceptions where CARB may transfer compliance instruments out of an entity's compliance account. These include if an entity is eligible to exit or voluntarily participate in the cap-and-trade program because it has shut down or stayed below the emissions threshold for inclusion in the program, or if the entity has conducted a market transaction resulting in a facility change of ownership. For the jurisdiction accounts, the compliance instrument report shows 6 individual or combined California and Quebec accounts. These accounts include a California-specific Voluntary Renewable Electricity (VRE) account, the Combined Auction plus Issuance plus Allocation account, the Combined Retirement account, a California-specific Invalidation account, and the Combined Reserve account. The report also shows a Quebec-specific Environmental Integrity account. For this video, we'll focus only on the California-specific and joint jurisdiction accounts. First, California has a Voluntary Renewable Electricity (VRE) account. The regulation includes a mechanism to help support voluntary investment in renewable resources and identifies when these allowances may be retired on behalf of VRE program participants. These allowances are a special designated use type of allowance, set aside by CARB and issued directly to the VRE account, and then directly retired to CARB's retirement account on behalf of VRE program participants. These allowances do not enter market circulation, cannot be used to satisfy a compliance obligation, and cannot be traded or held by an entity at any point in the entity accounts. Second, as of Q2 2019, the jurisdiction accounts with the greatest allowance balance is the combined jurisdiction auction plus issuance plus allocation accounts. Over time, older vintage year balances decrease as those allowances enter market circulation and then are surrendered back to the jurisdictions for compliance and retirement. Third, in the jurisdiction retirement account, we see that as of August 2019, all entities with covered emissions registered to California and Quebec will have completed the compliance events for Compliance Period 1 and Compliance Period 2. For those compliance events, eligible vintage allowances included vintage 2017 allowances to account for 2017 covered emissions and prior year emissions through 2013, as well as any true-up quantity provided to California entities with vintage years 2018 and 2019 allowances. As far as offset credits, the other type of eligible compliance instrument, entities could surrender offset credits to meet up to 8% of their full compliance obligation due for each compliance period. This explains the overall larger balance of vintage year 2013 to 2017 allowances and offset credits observed in the joint California and Quebec retirement accounts. As described in the footnotes section of the report, from January 1st to July 3rd, 2018, Ontario joined the linked cap-and-trade program, and instruments and accounts registered to Ontario were valid for compliance purposes, trading, or selling among all market participants. On July 3, 2018, the Government of Ontario filed a regulation that revoked the Ontario Cap-and-Trade Regulation and suspended all Ontario Entity KITS accounts. As of that date, there were 13,186,967 more allowances held in California and Quebec accounts than the total number of allowances issued by those two jurisdictions alone. To maintain environmental stringency of the joint market, California subsequently retired 11,340,792 allowances of vintage years 2021 to 2030 on June 27, 2019, and Quebec retired 1,845,175 vintage 2017 allowances on July 10, 2019. Prior tabs of the report also explain retirement of allowances due to an entity's bankruptcy case and allowances that were retired as a result of the California Independent System Operator or CITSS Energy Imbalance Market or EIM. Under AB 32, CARB must account for statewide greenhouse gas emissions, including all emissions resulting from the generation of electricity delivered to and consumed in California, whether that electricity is generated in-state or imported to California to serve California load. In 2015, CARB found that the design of EIM does not fully account for the greenhouse gas emissions experienced by the atmosphere from imported electricity. To address California's 2016 and 2017 emissions not captured by the EIM, CARB retired allowances in the first quarter of 2019. The Quarter 1 2019 tab of the Compliance Instrument Report shows the transfer of allowances equal to the additional EIM outstanding emissions from the jurisdiction auction account to the jurisdiction retirement account. Fourth, the report shows the California-specific offset invalidation account. In order to ensure the environmental integrity of the California Cap-and-Trade program, and specifically of the Compliance Offset Program, the Cap-and-Trade regulation includes a mechanism to invalidate any issued A or B offset credits if it is later determined that the A or B offset credits resulted from 1. An overstatement of more than 5%, 2. Offset project activities were not in conformance with all relevant local, state, and national environmental and health and safety laws, or 3. Double counting with any other voluntary or mandatory greenhouse gas reduction program. If CARB determines that an offset credit is invalid after it is issued, CARB will cancel the credit in CITSS. In the event that the offset credit was surrendered and retired for compliance, the user of the offset credit is required to replace it with another valid compliance instrument. If the offset credit has not been retired or surrendered for compliance, then the offset credit is simply invalid and unavailable to be surrendered for compliance at a later time or traded with another market participant. If CARB has invalidated an offset credit, it will be placed into the invalidation account. As of Q2 2019, we can observe 88,955 California ozone depleting substance offset credits in the invalidation account. This is less than 0.07% of the over 135 million total A or B offset credits issued as of Q2 2019. Finally, the remaining jurisdiction accounts are reflected as a joint reserve account. Both California and Quebec have cost containment mechanisms that put aside a specified number of non-vintage allowances for sale by the jurisdictions at a higher price. For this presentation, we will focus on the California Reserve Sale mechanism. For 2019 California Reserve sales, the lowest reserve tier price of Tier 1 is calculated as $58.34 per allowance with 13,537,000 total reserve allowances available in that tier. Tier 2 is calculated as $65.65 per allowance with 13,537,000 allowances available in that tier. And finally, Tier 3 is calculated as $72.93 per allowance with 34,428,247 allowances. These allowances can be purchased by eligible covered and opt-in covered entities only, and any purchased allowances would go directly into the entity's compliance account. In California, starting in 2021, this reserve structure will change pursuant to Assembly Bill 398 and 2018 regulatory amendments. There will be an additional price containment mechanism where CARB would operate price ceiling sales in the event that entities do not have sufficient eligible compliance instruments in their holding and compliance accounts for the next compliance surrender deadline. And these entities are able to purchase only what is needed to meet their compliance obligation for the next surrender deadline. The price ceiling or maximum price by which CARB would offer allowances under this price containment mechanism is set as $65 in 2021 and will increase annually by 5% plus the rate of inflation. Finally, as reflected in the APCR account balance in the Compliance Instrument Report, CARB has a mechanism that removes any auction allowances that remain unsold for more than 24 months from the jurisdiction auction account to California's APCR account. As of August 2019, a total of 37,076,922 vintages 2016 and 2017 California allowances were moved to the APCR account under this provision. Through 2020, the current California Reserve is estimated to contain 160.8 million California allowances in total, with 63.6 million allowances available for each of the three tiers. Starting in 2021, the new post-2020 California Reserve tiers and price ceiling will replace the pre-2021 APCR. The new post-2020 Reserve tiers and price ceiling will contain 213.2 million California allowances that will be offered at the 2021 prices of $41.40 for Tier 1 allowances, $53.20 for Tier 2 allowances, and $65 for price ceiling instruments. This now concludes Video Module 2 on the Compliance Instrument Report.
The Compliance Instrument Report provides one snapshot of allowance holdings per calendar quarter. Video Module 2 describes holdings in the Compliance Instrument Reports tab for the second quarter of 2019. The report available on CARB's website will contain one tab per quarter from the second quarter of 2014 to the most recent quarter. By comparing allowance holdings across quarters, or report tabs, it is possible to create visualizations of changes in allowance disposition over time. This Excel stacked area custom combination chart shows changes in allowance disposition and entity accounts over time. For a given point in time or location on the bottom time axis, the height of the chart's grid pattern area equals the total allowance holdings in entity general accounts. The blue shaded color area of the chart shows total allowance holdings in entity compliance accounts. The chart was created using information from quarterly compliance instrument reports from quarter 2 2014 through quarter 2 2019. As discussed in the second video module, the compliance instrument report gives allowance totals by account type for the joint California and Quebec market. This means allowances shown in this chart are the totals for Quebec and California entities, rather than just California entities. Allowance totals in the chart are limited to the allowances eligible to satisfy 2013 through 2017 compliance obligations. Let's take an example point in time to better understand the chart. In the third quarter of 2015, the top of the grid pattern reaches 750 million allowances. We see that entity compliance accounts, the blue shaded area, held around 330 million allowances. In the third quarter of 2015, we also see that entity general accounts held another 420 million allowances, or the difference between the top and the bottom of the grid pattern. The sum of entity compliance and general holdings for the third quarter of 2015 is approximately 750 million allowances. Understanding that the Compliance Instrument Report reflects all compliance instruments in the joint California-Quebec market helps to compare holdings immediately prior to linkage between California and Quebec on November 1, 2014, and immediately after linkage. This linkage is part of the reason for a jump in the fourth quarter 2014 entity holdings as compared to the third quarter 2014 entity holdings. In the third quarter of 2014, only California allowances were eligible for compliance in the California market, and so only California allowance totals were included in the Compliance Instrument Report. Starting with the fourth quarter of 2014, California and Quebec's allowances are included in the Compliance Instrument Report. Both jurisdictions' allowances became eligible for compliance use in either jurisdiction's cap-and-trade program. While Ontario briefly joined the joint market in Q4 of 2017 and Q1 of 2018, their estimated private entity account holdings were excluded from the chart on this slide for those 2 quarters, although a small number of Ontario allowances held by California and Quebec entities are included in the chart's allowance totals from Q2 of 2018 to the end of the time period. Those allowances were fully accounted for when California and Quebec retired an equivalent number of allowances in mid-2019. Beginning in 2015, transportation, fuel, and natural gas suppliers were subject to the cap-and-trade regulation. This nearly doubled the size of the program and is reflected in the slide by an increased rate of accumulated allowances in entity accounts from the beginning of 2015 through the third quarter of the year, as the market expanded to include these sectors. Now look at the end of 2015. We can see the first drop in holdings between 2015 Q3 and 2015 Q4, when the November 1st compliance event occurred. A total of 278,408,105 allowances were surrendered and placed in California and Quebec's jurisdiction retirement accounts for 2013 and 2014 covered emissions obligations due to CARB in Quebec. The full compliance period compliance event at the end of a compliance period is when the majority of emissions are accounted for. Once fuel suppliers and natural gas suppliers were subject to the cap-and-trade regulation, The next full compliance period compliance event occurred on November 1st, 2018. Following linkage with Quebec in 2014, we see a steady increase in compliance holdings from 2015 to the first half of 2018 in anticipation of the full compliance period compliance obligation for 2015 to 2017 emissions. During this time, California entities were required to surrender allowances equal to 30% of 2015 emissions on November 1st, 2016, and 30% of 2016 emissions on November 1st, 2017. For Compliance Period 2, the full Compliance Period compliance obligation deadline took place on November 1st, 2018. This event is visible in the chart as the 981,442,093 allowances moved out of private entity accounts into California and Quebec's retirement accounts. The private holdings tracked in this chart dropped from over 1 billion allowances to less than 200 million allowances. California entities were required to surrender compliance instruments for the remainder of 2015 and 2016 emissions, and 100% of 2017 covered emissions. Quebec entities surrendered allowances on November 1st, 2018 for 100% of their 2015, 2016, and 2017 emissions. Now we'll look at how Compliance Period 1 and Compliance Period 2 eligible allowances moved between different accounts from 2014 to 2019. As with the prior slide's entity-only chart, this Excel stacked area custom combination chart uses the information in the quarterly compliance instrument report. In addition to the prior slide's visualization of private entity holdings over time, the chart visualizes California and Quebec jurisdiction accounts as well. Allowances for 2013 to 2020 budget years were created before the start of the 2014 compliance instrument reports used for this graph. This is why the total number of Compliance Period 1 and Compliance Period 2 eligible allowances, the graph's height of 1.8 billion allowances, remains constant as the chart's x-axis moves from 2014 to 2019. The chart does make adjustments to remove the temporary expansion of allowances from Ontario linked accounts in Q4 of 2017 and Q1 of 2018. Let's take the chart categories one by one from top to bottom at one point in time. We'll start with a look above the last point in 2015, right before the jump in the bottom account volume. At the top of the chart, we see 141 million allowances in the Allowance Price Containment Reserve, or APCR for short, in dark gray. Video Module 2 discusses how the APCR was created from within the 2013 to 2020 caps and does not represent an expansion of the number of allowances in the market. The next account group, in dark gray and white lines, combines California and Quebec's auction, issuance, and allocation accounts, the California VRE, and California Limited Use Holding accounts. The allowances are grouped together because the majority of these accounts' allowances are either auctioned during the quarterly auctions or transferred from California and Quebec to compliance entities for allocation purposes. Video Module 2 describes the VRE. Video Module 3 describes a feature of industrial allocation called true-up that results in a small number of vintage 2018 and 2019 allowances to be displayed in this chart. The blue polka dot and light blue shaded areas are the private entity general account and compliance account volumes that we saw in the prior slide. As with the prior slide, we see the same 750 million allowances in the third quarter of 2015. This is the distance between the bottom of the light blue area to the top of the blue polka dot area. The bottom dark gray hashed area shows the allowances held in Quebec and California's retirement accounts. Now, let's move from 2014 to 2019, left to right in the graph. The APCR has never been accessed, so it remains constant in volume from 2014 to 2018. California has a self-ratcheting mechanism that removes unsold allowances from the market during periods of low demand for allowances. This self-ratcheting mechanism is meant to ensure low demand for allowances does not mute the carbon price signal. The first time this mechanism was utilized was after undersubscribed auctions in 2016 and 2017, where the state did not fully sell all available California allowances. Allowances that remained unsold after 24 months were moved into the APCR pursuant to the self-ratcheting mechanism. Ultimately, the mechanism has moved 37 million allowances as of August 2019 into the APCR. The Auction Summary Report for 2016 and 2017 auctions provides detailed information on the total allowances sold and the remaining unsold vintage year 2016 and 2017 allowances. We see the grouped set of jurisdiction accounts gradually shrinking over time. This makes sense. Many of these allowances gradually entered private circulation through auctions and allocation, with some moving to the APCR as a result of California's self-ratcheting mechanism. By the middle of 2019, only a small number of the allowances shown in this graph remain in these grouped accounts: the jurisdiction auction, issuance, allocation, and VRE accounts, and private entity limited use holding accounts. The number of allowances and entity accounts expands over time in preparation for the November 2015 and 2018 multi-year compliance events. Movement of allowances into these accounts was described in greater detail on the prior slide. Finally, there is an incremental expansion in the number of allowances held in the jurisdiction retirement account during California's partial compliance events of November of 2014, 2016, and 2017. This is a direct flow of allowances and offsets from California compliance entity accounts to the retirement account. The number of allowances grows substantially during the 2015 and 2018 multi-year compliance events. In a moment, video module 3 on allowance allocation to industrial entities will start. The video module is also available to watch on CARB's Cap and Trade website at www.arb.ca.gov/cap-and-trade-program-data. The module will walk through why CARB allocates to industrial covered entities and examples of allocation and emissions for two covered sectors using public information. First, we'll compare allowance allocation and covered emissions for the dairy sector. Then, we'll compare allowance allocation and covered emissions for the petroleum refining and hydrogen production sector. Welcome to Video Module 3, Understanding Industrial Allocation. The video module is also available to watch on CARB's Cap and Trade Program Data website at www.arb.ca.gov/cap-and-trade-program-data. In this video, we'll focus on CARB's public information on industrial allocation, that is, CARB's direct transfer of allowances to industrial covered entities. On this data webpage, you can access various reports on compliance, allocation, registration, holdings, transfer summaries, other market data, as well as the links to this presentation and 4 separate video modules. By the end of this video module, we'll know how to use public data to match the numbers that support the webinar charts in slides 16 and 17. CARB is often asked, why do we transfer allowances to covered industrial entities at all? The Cap and Trade program adds a cost to production, which may not exist in other regions. Competitive industries with similar businesses in those regions could start to shift production out of California to avoid this added cost. This results in emissions leakage, where production shifts outside of California, but total emissions have not gone down. To protect those companies and address competitiveness concerns, CARB provides allowances to prevent leakage. CARB gives industrial allowance allocation for in-state production, not for those entities' emissions. Industrial allocation declines over time to encourage industrial greenhouse gas reductions. Let's preview the rest of the module by looking at the slides of each sector. Slide 16 shows California's dairy sector. Slide 17 shows California's refining and hydrogen production sector. Notice that in both charts, the left column, emissions, is greater than the right column, allowance allocation. This means that CARB's allocation does not fully cover the emissions of these industrial sectors. Because industry does not receive allowances equal to their emissions, they still must decide to either reduce emissions on-site or purchase allowances. The financial signal to take action remains. Let's look through the applicable reports on CARB's website to calculate the dairy numbers. First, we'll calculate covered emissions, or the left column of the chart. We can use CARB's public allowance allocation reports to figure out which facilities are in the dairy sector. We can find the facilities using their NAICS codes, which classify facilities by the type of business they conduct. Let's go to the Cap and Trade homepage, expand Publicly Available Market Information, click on All Cap and Trade Program Data, and then in the Allocated Allowances section, we'll click on the Vintage 2017 link to download CARB's Vintage 2017 Allocation Report. After opening the report, we'll scroll to page 8. We see that California's dairy sector is made up of facilities in two NAICS codes, 311513 and 311514. Let's write those codes in a Word document and leave it open. CARB doesn't publicly release facility-specific allocation information, and in some cases, disclosing allocation for each NAICS code would reveal confidential facility-specific production information. We must balance transparency with protecting confidential business information. Now we can go to the MRR emissions data. From the Cap and Trade Program Data page, click on the Mandatory Greenhouse Gas Reporting link. This takes us to the Reported Data page visible on the left-hand navigation menu. Click on 2017 Greenhouse Gas Facility and Entity Emissions to open the 2017 data in Excel. Click on the third tab, 2017 Greenhouse Gas Data, in the Excel spreadsheet. Each facility's emissions with a Cap and Trade compliance obligation are shown in column R, Total Covered Emissions. Each row corresponds to one covered facility. NAICS codes are in column AB. We can locate facilities in the dairy sector by filtering column AB to show only the two dairy NAICS codes, 311513 and 311514. When we sum covered emissions for those facilities in column R, we get 408,458 metric tons of carbon dioxide equivalent. This is the emissions shown by the left column of slide 16. Now that we've calculated emissions, we'll move on to the right-hand column, allowance allocation for 2017 production. To understand how to use the allocation reports, you need to know a bit about allocation timing. Allowance allocation for production in a given year is provided in two phases, an initial allocation and a true-up allocation. First, we provide an initial allocation in advance of the year based on the most recent available production data, which is for the year 2 years prior. Then, we provide a true-up allocation that adjusts the initial allocation to the final allocation amount for the given year. True-up is provided after the given year and is based on verified actual production data for the year. For example, CARB provided initial vintage 2017 allocation for 2017 production in October of 2016 based on verified 2015 production, which served as an estimate of future 2017 production. CARB received verified actual 2017 production data in August of 2018. CARB then provided the true-up allocation of the initial vintage 2017 allocation in October of 2018 in the form of vintage 2019 true-up allowance allocation. This annual reporting and allocation schedule holds each year for all industrial facilities with product-based allowance allocation. Start by finding the initial allocation to the dairy sector for 2017 production. This is on page 8 of the Vintage 2017 allocation report we already downloaded. Copy both the total allocation and total true-up value numbers into the Word document we started. If you look again at slide 16, you see that the total allocation of 342,845 allowances from the 2017 allocation report doesn't match the graph's 341,604 allowances. This is because CARB adjusted the Vintage 2017 initial allocation once we received verified 2017 production data from each facility in 2018. If a facility had more production in 2017 than in 2015, the production year the initial allocation was based on, CARB provides the facility additional allowances to match its actual 2017 production. If it produces less, CARB takes back some allowances. We call giving extra allowances positive true-up and taking back allowances negative true-up. Let's look at how much positive true-up allocation dairy facilities had for their verified 2017 production. Because of the delay between providing initial allowance allocation and receiving actual verified industrial production data, CARB gave dairy facilities true-up allocation for 2017 production during the Vintage 2019 allocation, 2 years after the initial allocation. So we need to go to the Vintage 2019 allocation report. The Vintage 2019 allocations to the dairy sector are on page 8 of the 2019 report. Let's write these total allocation and total true-up value numbers in the Word document as well. Now we can calculate the estimate of allocation for dairy's 2017 production that is shown on the graph on slide 16. The 2017 total allocation value of 342,845 allowances includes some true-up allocation for 2015 production. To estimate initial Vintage 2017 allocation, subtract 2017 total true-up value, which is targeted at 2015 production, from 2017 total allocation. To this estimate, we add the 2019 total true-up value, which is targeted to 2017 production. This gives our estimated allocation for 2017 production of 341,604 allowances on the right side of the dairy graph on slide 16. Now let's look at allocation to the refining sector. We'll calculate allowance allocation to the petroleum and hydrogen production sector for 2017 production. We'll also look at the 2017 emissions for this sector, as well as 2017 emissions associated with the combustion of transportation fuels produced by the petroleum refiners, such as gasoline and diesel. We'll see that allocation only covers about 13% of these emissions. We'll start with fuel supplier emissions. Emissions reporting to the U.S. EPA and CARB is divided into subparts based on the category of emissions. Reporting subparts are provided in column AC of the MRR 2017 emissions report, and subpart MM corresponds to emissions from fuel suppliers. We'll scroll to column AC and filter for subpart MM and MMNN. We can sum the covered emissions values in column R. The 160,750,086 metric tons CO2e match the total covered emissions shown in the graph on slide 17. Note that fuel suppliers do not receive allocation. Next, we'll look at the on-site 2017 covered emissions for the petroleum refining and hydrogen production sector. On page 2 of the Vintage 2017 allocation report, we see that facilities in these sectors that receive industrial allocation operate in 3 NAICS codes, 324110, 324199, and 325120. In column AB of the 2017 MRR data, we'll filter for these three NAICS codes. Then we'll filter column AC for the appropriate subparts that correspond to on-site covered emissions for the petroleum refining and hydrogen production sector. Subpart Y corresponds to on-site emissions from petroleum refining. Subpart P corresponds to on-site emissions from hydrogen production. And subpart C corresponds to on-site emissions from general fuel combustion at any facility. Subpart PP is used to report carbon dioxide that is captured and supplied off-site, an activity conducted by some petroleum refining and hydrogen production facilities. Only facilities with a combination of subparts C, P, PP, and Y in column AC should be included to properly represent on-site covered emissions for the petroleum refining and hydrogen production sector. Summing the total covered emissions in column R, we see that the total 35,402,105 metric tons CO2e matches emissions shown in the graph on slide 17. Next, we'll estimate allocation to the petroleum refining and hydrogen production sectors. We will follow the same strategy as we used for the dairy sector. Let's go to page 2 of the Vintage 2017 Allocation Report and write down the total allocation and total true-up values. Then, let's go to page 2 of the Vintage 2019 Allocation Report and write in the total allocation and total true-up values. We can estimate the Vintage 2017 initial allocation by subtracting total true-up value from total allocation for Vintage 2017 allocation. This gives 23,894,830 allowances. Then we'll add the Vintage 2019 total true-up value of 2,463,877 allowances to the Vintage 2017 initial allocation. The sum matches the 26.36 million allowances shown in the chart. As you can see, the total allocation to this sector only covers about 13% of the sector's emissions. This concludes video module 3. The webinar will now move on to a short restatement of the allowance allocation chart information, and then move to information on the compliance offset program. Video module 3 on allowance allocation to industrial entities provides a more detailed discussion of this chart. On this slide, the chart shows that covered entities in the petroleum refining and hydrogen production sector had a 2017 compliance obligation of 35,402,105 metric tons of carbon dioxide equivalent. Allowance allocation to the same sector was 26,358,707 allowances. In addition, fuel suppliers that sell the refining sector's product had a 2017 compliance obligation of 160,750,086 metric tons of carbon dioxide equivalent. Fuel suppliers do not receive any allowance allocation. Taken together, allowance allocation covers about 13% of these emissions. This table helps find California fuel suppliers' 2017 emissions covered by the Cap-and-Trade program. Fuel suppliers sell the products of covered entities in the petroleum refining and hydrogen production sector. Fuel suppliers' 2017 emissions are displayed in the gray dotted pattern section of slide 17's left-hand column. Fuel suppliers' 2017 emissions were 160,750,086 metric tons of carbon dioxide equivalent. We recommend watching video module 3 on allowance allocation to learn how this table can help calculate the emission total for fuel suppliers on slide 17. This table helps find 2017 emissions for the petroleum refining and hydrogen production sector. The sector's 2017 emissions are displayed in the dark blue section of slide 18's left-hand column. The sector's 2017 emissions were 35,402,105 metric tons carbon dioxide equivalent. We recommend watching the Allowance Allocation video module to understand this table in the context of how to recreate the overall allowance allocation chart to the petroleum refining and hydrogen production sectors on slide 17.
CARB releases annual summary reports that provide average price statistics for allowances and offset values based on CITSS transfer data. Using the most recent Market Transfer Summary Report, it is possible to determine a rough estimate of the total financial value for California's Compliance Offset Program, or what we call an offset premium, using the weighted average prices provided in the report, the total quantity of offset credits issued, which is provided in the publicly available offset issuance table updated twice a month or as provided in the quarterly compliance instrument report, and the auction reserve price from the last auction. Based on the 2017 Market Transfer Summary Report data, the weighted average prices of offsets and allowances were $11.89 and $14.33 respectively. This means that offsets were available at approximately 83% of the price of an allowance, a discount of 17%. Applying this discount to the 2019 auction reserve price of $15.62 for allowances gives an approximate offset price of $12.96 for 2019. Based on the 2019 Quarter 2 Compliance Instrument Report, the total quantity of California offset credits issued, not accounting for the forest buffer, is roughly 136 million offset credits, an investment value of $1.7 billion towards non-covered sectors. This value is expected to increase as allowance price increases at an annual rate of 5% plus inflation, and we issue more credits for offset projects that meet stringent project requirements and reduce emissions or achieve increased carbon sequestration. This aspect of the program is just one part of the larger climate efforts to reduce greenhouse gas emissions. It should be noted that offsets trade at a lower amount than the allowances we sell at auction because of the risk involved with project reversals. ARB has created a forest buffer pool to account for the risk attributed to forest offset projects where carbon is not permanently sequestered. Some forest offset credits are placed into this insurance buffer pool to compensate for potential reversals due to forest fires, pest infestations, and other unintentional events. The size of this buffer pool is currently at 20 million forest project offset credits based on the 2019 Quarter 2 Compliance Instrument Report, a value of $259 million. This is a screenshot of the 2017 Market Transfer Summary Report. To determine an estimated value for the Compliance Offset Program, take the weighted average price from this report and refer to the most recent auction reserve price, and either the offset issuance table or compliance instrument report as described on the previous slide. The weighted average price for total offsets is shown in this report as the third column in the price transfers category. This is the second section of the presentation, overview of publicly available data, where general information is provided on the full range of information released about the Cap and Trade program. This section explains resources on available compliance instrument prices, a detailed description for the allocation process to industrial sectors, electric distribution utilities, and natural gas suppliers. This section is roughly 30 minutes long with one video module, Video Module 4. Video Module 4 covers auction data and demonstrates where to access auction notices, results, and statistics, and a summary of auction proceeds generated to date. There are some general slides on the Compliance Offset Program that explain the issuance of offset credits and information on offset project third-party verification bodies. The final slides include an overview of program compliance and enforcement, and a final summary of resources and web pages referenced throughout this presentation.
This table summarizes the Cap and Trade program reports and related reports by topic and provides the release timeframe for each report. Links to these reports are provided throughout the presentation and on the last slide. The annual GHG Facility and Entity Emissions Report summarizes greenhouse gas emissions reported pursuant to the regulation for the mandatory reporting of greenhouse gas emissions, or MRR for short. CARB publishes this report in November for GHG emissions from the previous year. Video Module 1, earlier in this presentation, provides an overview of GHG facility and entity emissions reports in the context of understanding Cap and Trade program compliance obligations. CARB publishes the California Greenhouse Gas Emission Inventory annually. Each edition of the inventory covers statewide greenhouse gas emissions for the year 2000 through the year 2 years prior to publication. For example, The 2019 edition of the inventory covers 2000 to 2017 greenhouse gas emissions. CARB prepares the inventory using data reported pursuant to MRR, data from other CARB programs, and data from other state and federal agencies. For the Cap and Trade program, CARB publishes annual allowance allocation summaries every December. Video Module 3, earlier in this presentation, illustrates the use of allowance allocation summaries in the context of understanding allocation to specific sectors. CARB publishes a list of all offset projects that have been issued offset credits and updates the offsets issuance table every other Wednesday. This report lists all offset projects that have been issued ARB offset credits, their invalidation status, and provides links to the relevant listing and other project-related materials that are required to be made public pursuant to the Cap and Trade regulation. CARB releases auction reports on a quarterly schedule corresponding to the quarterly auction dates. Auction notices are published 60 days prior to each auction. Summary results reports are published 1 week after each auction, and post-joint auction public proceeds reports are published approximately 4 weeks after each auction. In addition, CARB publishes an annual auction reserve price notice and an annual allowance price containment reserve notice every December. We will discuss the content of auction reports later in this presentation and in Video Module 4. CARB publishes the CITSS Registrant Report and Compliance Instrument Report quarterly, and the Summary of Market Transfers and Compliance Report every December. These reports were discussed earlier in the presentation and in Video Modules 1 and 2. CARB enforces rules to protect the integrity of the carbon market. Information on cases settled in lieu of litigation and those resolved by civil or criminal litigation is available through CARB's Enforcement Case Settlements webpage, which is updated monthly. CARB's California Climate Investments Program publishes an annual report on the expenditure of auction proceeds. The resources slide at the end of this presentation provides links to the web pages where all of these reports can be accessed.
CARB is continually assessing, in conjunction with our linked partner Quebec, additional ways of showing program data to aid the public and market participants in better understanding the program and the market data. By way of example, this chart was published in July 2019 and displays historical carbon allowance prices from auctions and secondary markets of carbon allowances. Auction prices shown on this chart include the current auction settlement price and auction reserve price. The auction reserve price for each current auction is depicted on the chart with a dark blue line, starting on November 2014 with the first joint California and Quebec auction held on November 25, 2014. The auction reserve price increases each calendar year by 5% plus the rate of inflation as measured by the most recently available 12 months of the Consumer Price Index for all urban consumers. The current 2019 auction reserve price is $15.62. The joint November 2014 auction included a current auction of 2014 vintage allowances and an advance auction of 2017 vintage allowances. The reserve, which is commonly referred to as the minimum price at which allowances offered in the current auction could be sold, was set at $11.34. The final settlement price for the current auction was $12.10 since the total qualified bids to purchase current vintage 2014 allowances exceeded the total allowances available for sale. The current auction settlement price is shown as dark blue triangles on this chart. The May 2019 auction settlement price was $17.45, the highest settlement price compared to past auction results and in line with secondary market prices. The reserve prices and the settlement prices displayed in this chart come from publicly available reports discussed on slide 25 and later in this presentation. The secondary market price reflects transactions that occur outside of the jurisdiction joint auctions. Secondary market prices are shown as a blue line. These prices reflect the cost of purchasing allowances from private parties rather than from the jurisdiction joint auction. This historical price chart illustrates that prices in the secondary market track closely with auction settlement prices and that over the last 5 years, the value of carbon allowances increased over time in both the primary auction and secondary markets as the carbon market continues to mature. CARB releases data for simultaneous public access on auction prices, prices of allowance, price containment reserve allowances for each reserve tier, and the ceiling prices set forth by the Cap and Trade Regulations cost containment features. Advance notice for auction and reserve sales is provided on CARB's webpage by the date and time specified in the regulation. There is also the Market Transfer Summary Report that is released each year that provides an annual summary of priced and unpriced CITSS allowance and offset transactions. The summary table provides weighted average prices, unweighted mean and median prices, and unweighted standard deviations in both US dollars and Canadian dollars. For certain offset types, fewer than 3 transfers where it may be possible to identify the price and counterparties to transactions, those transactions are placed in an unpriced category. In addition, transaction agreements that are between corporate associates or that bundle compliance instruments with other products are categorized as unpriced. Previously on slides 20 and 21, we reviewed an example of how the Market Transfer Summary Report can be used to estimate a total program value for the Compliance Offset Program. Listed on this slide are a few of the many resources that offer market participants the ability to track prices of futures contracts and options in the secondary carbon market of compliance instruments. In addition to exchange platforms, there are also subscription services for pricing data and free materials published by the U.S. Commodities Futures Trading Commission, California Energy Commission, and others.
CARB primarily allocates allowances to 3 sectors for specific purposes. These 3 sectors are industrial entities, electrical distribution utilities, and natural gas suppliers. CARB allocates allowances to electrical distribution utilities and natural gas suppliers to protect ratepayers from the cost burden of compliance with the program in accordance with the goals of AB 32. CARB allocates allowances to industrial entities for 2 reasons: transition assistance, as the economy adapts to a carbon price, and leakage prevention. CARB publishes allocation information in annual summaries and in the electrical distribution utilities allocation tables, posted on the Cap and Trade Program Data webpage. The annual allowance allocation summaries provide allocation information by allocation methodology. In these reports, industrial allocation data are disaggregated by general industrial activity. The electrical distribution utility allocation tables provide the allocation amount for each electrical distribution utility. The summary of 2013 to 2017 Electrical Distribution Utility Allocated Allowance Value Usage Report covers how electrical distribution utilities have used the value of allowances allocated to them, which we will discuss further on slide 32. For Vintage 2017, Vintage 2018, and Vintage 2019 allowance allocation, industrial allocation accounted for approximately 1/4 of total allocation to entities. Natural gas supplier allocation accounted for another 1/4, and electrical distribution utility allocation for 1/2 of total allocation to entities. The industrial allocation 1/4 includes other allocation, which refers to allocation for legacy contracts, universities and public service facilities, waste-to-energy facilities, and public wholesale water agencies. CARB allocates allowances to industrial entities to provide transition assistance and to prevent emissions leakage. Industrial allocation smooths the change to an economy with greenhouse gas emission costs by giving industry time to identify and invest in cost-effective emission reductions. It also minimizes the risk that facilities will cease operations in California and move operations and associated emissions elsewhere. The level of industrial allocation was initially scheduled to decline over time as industry adjusts to a greenhouse gas price and adopts energy-saving and greenhouse gas emissions-reducing strategies. The figure on this slide illustrates this concept, in which transition assistance in the early years of the program alleviates short-term economic impacts and helps promote a smooth transition to a low-carbon economy. And it also illustrates that free allocation to minimize leakage will be maintained until adoption of similar greenhouse gas emission pricing policies by other jurisdictions, such that free allocation will not be needed to shield entities from leakage risk. The regulation specifies 2 methodologies for calculating an industrial facility's allowance allocation for a given year: the product-based methodology and the energy-based methodology. For the product-based methodology, the level of allocation is based on facility production and product-specific benchmarks. A benchmark is an emissions intensity metric in units of metric tons of carbon dioxide equivalent per unit of product, based on sector-wide activity in baseline years. The allocation examples earlier in this presentation walked through the calculation of product-based allocation for dairies and refineries. when the product-based methodology is not feasible because of facilities with complex processes or multiple products, or because needed data are not available, CARB uses the energy-based methodology to calculate allowance allocation. For the energy-based methodology, allocation is based on a fixed average historical energy use. Allocation to electrical distribution utilities is based on annual estimated emissions from resources needed to serve electricity demand. The regulation specifies the level of allocation for each electrical distribution utility for the years 2013 to 2030, and CARB provides this information in Excel format on the Cap and Trade Program Data webpage in the 2013 to 2020 Electrical Distribution Utility Allocation Table and the post-2020 Electrical Distribution Utility Allocation Table. CARB has different rules for how different types of utilities can use their allowances. Investor-owned electric utilities are required to consign all allowances to auction and provide the majority of the proceeds to ratepayers in the form of climate credits to residential ratepayers on their bills. Publicly owned utilities may use their allowances for compliance or to invest in GHG-reducing activities such as energy efficiency, renewable energy, and building and transportation electrification. For more information on use of allowance value, see the Summary of 2013 to 2017 Electrical Distribution Utility Allocated Allowance Value Usage Report on the Cap and Trade Program Data webpage. The example here shows a breakdown on the past use of those allowance proceeds by investor-owned utilities. For context, investor-owned utilities serve 3/4 of the state and receive 2/3 of the allowances allocated to electrical distribution utilities. Between the residential climate credit and residential volumetric return, 82% of the allowance value used from 2013 to 2017 was returned to residential customers. 7% was returned to small businesses, and another 7% was returned to energy-intensive trade-exposed, or EITE, industrial facilities. CARB also allocates allowances to natural gas suppliers for the purpose of benefiting ratepayers. Allocation to natural gas suppliers is based on the emissions from the amount of gas they sold in 2011 times the allocation year's cap adjustment factor, which represents the annual declining cap pursuant to the regulation. The annual allowance allocation summaries posted on the Cap and Trade Program Data webpage provide the level of allocation to the sector for past years. The natural gas supplier information is in the last few pages of the report following the industrial allocation table. Natural gas suppliers are allowed to deposit a portion of their allowances for compliance. They must consign the remainder to auction and use the proceeds to benefit ratepayers. The portion of allocated allowances that natural gas suppliers must consign to auction increases 5% per year, such that 100% must be consigned in 2030. Similarly to electrical distribution utilities, the majority of proceeds from the sale of allowances by natural gas suppliers is returned as a biannual climate credit to residential ratepayers. A portion of the proceeds is used for building decarbonization programs. Now let's move on to a discussion of auction-related information. CARB provides auction data in 3 reports published for each quarterly auction, in running summary reports, and in an annual auction reserve price notice. You can find these reports on the Cap and Trade Program Data and Auction Notices and Reports web pages. This slide provides links to the Auction Notices and Reports webpage, select the hyperlinked Quarterly Auction Reports heading, and to each report or recent example of the report. The auction data video module provided on the next slide will walk through each of these reports and where to find them on the Cap and Trade Program webpage. For each auction, CARB publishes an auction notice, a summary results report, and a proceeds report. CARB publishes an auction notice 60 days prior to each auction. The notice includes a summary of key auction dates and the number of allowances by vintage that will be offered at the auction. CARB publishes a summary results report 5 business days after each auction. Summary results reports provide the number of allowances offered and sold by vintage and by jurisdiction, settlement prices for the current auction and advance auction, qualified bid summary statistics, and a list of qualified bidders in the auction. Auction notices and summary results reports are jointly published by CARB in linked partner jurisdictions. so for current reports you will see they are published by CARB and Quebec. CARB publishes a California post-joint auction public proceeds report approximately 4 weeks after each auction. The proceeds report provides information about auction proceeds to the state of California and to investor-owned utilities and publicly owned utilities who consign allowances to auction. The auction settlement prices and results summary provides the number of allowances offered and sold and settlement prices for each auction. CARB updates this report quarterly when posting the summary results report. Similarly, CARB updates the auction proceeds summary quarterly when posting the California Post-Joint Auction Public Proceeds Report. The auction proceeds summary provides a summary of auction proceeds to the state of California and to consigning entities by fiscal year. The annual auction reserve price notice, published each December, provides California and Quebec's annual auction reserve prices and allowances to be offered for sale in the upcoming year. CARB publishes auction data on the Cap and Trade Program Data webpage and on the Auction Notices and Reports webpage. Select the video module for Auction Data link to watch an 11-minute overview of auction reports. The figure on this slide shows the auction results table from the Summary Results Report for the May 2019 joint auction, which is discussed further in the Auction Data video module. Welcome to the Auction Data video module. This video module is also available to watch on CARB's Cap and Trade Program Data website at www.arb.ca.gov/cap-and-trade-program-data. In this video, we will cover where to find auction data on the Cap and Trade Program website, and we will walk through each type of auction report. This page provides all program publications, organized by topic. At the bottom of the page, there are also links to data from other programs related to the Cap and Trade program. On this page, there are links to auction summary reports and annual reports, as well as a link to the Auction Notices and Reports page that has all of the quarterly auction reports. Select the Auction Notices and Reports link under the Auction Data. The Auction Notices and Reports page provides the auction settlement prices and results summary, the auction proceeds summary, all quarterly auction reports, that is, auction notices, summary results reports, and California post-joint auction public proceeds reports, and finally, annual auction reserve price notices. Let's walk through the reports in the following order. The 2019 Annual Auction Reserve Price Notice, next the Auction Notice, Summary Results Report, and then Proceeds Report for the May 2019 Joint Auction, and the Auction Settlement Prices and Results Summary and the Auction Proceeds Summary. The Annual Auction Reserve Price Notice, published each December, provides California and Quebec's annual auction reserve prices and allowances to be offered for sale in the upcoming year. Table 1 summarizes this information. Table 2 presents the prior year's annual auction reserve prices and the Consumer Price Index for each jurisdiction to show how the current year's annual auction reserve prices were established. The report discusses how the annual auction reserve prices and an auction exchange rate will be used to determine an auction reserve price the day prior to each auction. The report then discusses allowances offered for sale and reasons the quantity of allowances may fluctuate during the year. Finally, the report includes auction dates for the year. Next, we will look at the auction notice for the May 2019 joint auction. CARB publishes an auction notice 60 days prior to each auction. The notice includes a summary of key auction dates and the number of allowances by vintage that will be offered at the auction. The information provided in the auction notice is similar to the information provided in the annual auction reserve price notice, but the auction notice is specific to a particular auction as opposed to all auctions in a calendar year. The first page of the auction notice provides background information and links to guidance documents. The second page has the auction date and time and a discussion of allowances offered for sale. Table 1 provides the number of allowances offered for sale in the current auction and the advance auction. Table 2 shows the breakdown by vintage for the allowances offered for sale in the current auction. The discussion of annual auction reserve prices is similar to that provided in the annual auction reserve price notice. The rest of the auction notice is dedicated to instruction and the auction schedule. The auction schedule in Table 4 includes the dates that the next two reports that we look at, the Summary Results Report and the California Post-Joint Auction Public Proceeds Report, will be posted. Here is the Summary Results Report for the May 2019 joint auction. CARB publishes a Summary Results Report 5 business days after each auction. Summary Results Reports provide the number of allowances offered and sold by vintage and by jurisdiction, settlement prices for the current auction and advance auction, qualified bid summary statistics, and a list of qualified bidders in the auction. Table 1 presents the number of allowances offered and sold. The top half of the table shows allowances offered, and the bottom half shows allowances sold. The data is presented by jurisdiction or entity consignment, by current auction or advance auction, and by vintage for the current auction. The California entity consignment lines are for allowances offered and sold by California entities consigned allowances to the auction. The CARB lines are for allowances offered and sold by the state of California. And the MELCC lines are for allowances offered and sold by the province of Quebec. Table 1 also presents some auction statistics in the last 3 rows of the table. Table 2 presents qualified bid summary statistics, including settlement prices and maximum, minimum, mean, and median bid prices. Note that starting with the August 2019 joint auction, the auction results tables in this report are presented a little differently. The auction results table is presented as 2 tables, and the bid summary statistics table becomes Table 3. There are also small changes to the table formatting and row titles, but the general layout of the data is the same as presented for the May 2019 joint auction. A list of qualified bidders is provided starting on page 4 of the report. A qualified bidder is an entity that completed an auction application, submitted a bid guarantee that was accepted by the Financial Services Administrator, and was approved to participate in the auction by the jurisdictions. The last few pages provide explanatory notes that define the bid statistics provided in Tables 1 and 2. Now we will look at the California Post-Joint Auction Public Proceeds Report for the May 2019 joint auction. The auction notice and summary results report that we just reviewed were joint reports with Quebec. The data in those reports represents both jurisdictions. In contrast, this proceeds report is a California-specific report that covers auction proceeds to the state of California and to investor-owned and publicly owned utilities who consign allowances to auction. CARB publishes proceeds reports approximately 4 weeks after each auction. As the report explains, the summary results report that we just looked at did not include the auction proceeds because of the need to complete the currency exchange required to determine final proceeds payments in a joint auction. On page 2, the report reiterates some of the key auction results metrics from the summary results report, including settlement prices and allowances offered and sold. The paragraph at the bottom of page 2 discusses the number of allowances sold and the corresponding proceeds to investor-owned utilities and publicly owned utilities. The table on page 3 presents proceeds from the May 2019 joint auction, as well as total auction proceeds to date. The proceeds are shown by quarter for the current fiscal year and by fiscal year for previous fiscal years. Proceeds from the sale of California state-owned allowances in the May 2019 joint auction are listed in the first row, Q2 2019 May. The proceeds amount of $743 million corresponds to the allowances sold in the current auction and advance auction, listed in the CARB line in the auction results table on page 2. As mentioned previously, the proceeds will not exactly equal allowances sold multiplied by the settlement price because of the currency exchange process. The last 2 reports that we will walk through summarize auction results and proceeds for all auctions to date. This is the auction settlement prices and results summary. CARB updates this report quarterly when posting the summary results report 5 business days after each auction. The report is organized with the most recent auction on top and with page breaks signaling a change in the participating jurisdictions. As of the May 2019 version of the report shown here, the first page includes the 4 most recent auctions, all of which were California-Quebec joint auctions. Page 2 has the 2 California-Ontario-Quebec joint auctions held in 2018. Page 3 lists the California-Quebec joint auctions held from November 2014 through November 2017. And page 4 has the first 8 auctions held by California, which didn't include any linked jurisdictions. Moving back to page 1, we can look at the auction results for the May 2019 joint auction, which corresponds to the data we looked at in the summary results report for this auction. This report provides the total allowances offered, total allowances sold, and settlement price for the current auction and advance auction. The allowance quantities include allowances offered and sold by all participating jurisdictions and consigning entities. The breakdown by jurisdiction is only provided in the summary results report that we looked at previously. Lastly, we will look at the auction proceeds summary. CARB updates this summary quarterly when posting the California Post-Joint Auction Public Proceeds Report, approximately 4 weeks after each auction. This report lists auction proceeds to investor-owned utilities, publicly owned utilities, and the state of California by fiscal quarter for the most recent fiscal year, and by fiscal year for prior years. This concludes our overview of auction reports. For more information on auctions, visit the Auction Information webpage, which you can access from the Cap and Trade Program webpage by selecting Auction Information. In this video, we skipped over the Auction Information webpage and went directly to the Auction Notices and Reports page because we were focused on auction data. But the Auction Information webpage also has links to the most recent auction reports in addition to background information, guidance documents, and forms related to auctions. Thank you for watching this video. Auction proceeds from the sale of California state-owned allowances are deposited into the Greenhouse Gas Reduction Fund. The legislature then appropriates money from this fund to state agencies that administer California climate investments programs. As of the May 2019 joint auction, approximately $11.1 billion have been deposited to the Greenhouse Gas Reduction Fund, as shown in the auction proceeds summary report discussed previously and linked at the bottom of this slide. The California Climate Investments Program prepares annual reports that describe the statuses of funded programs and list the projects funded. The annual reports also estimate the greenhouse gas reductions expected from project investments and provide key statistics on benefits to disadvantaged communities, demand for funding and leveraging, fiscal data, and program accomplishments. As of the 2019 annual report released in March 2019, the legislature has appropriated $9.3 billion to administering agencies, and $7.4 billion have been selected and awarded to funding recipients. This slide provides links to the California Climate Investments webpage, the 2019 annual report, and an interactive California Climate Investments project map. In addition to allowances, CARB issues offset credits for projects that meet stringent eligibility and quantification requirements. An ARB offset credit is a tradable compliance instrument issued by CARB that represents a GHG reduction or GHG removal enhancement of 1 metric ton of carbon dioxide equivalent. The GHG reduction or GHG removal enhancement must be real, additional, quantifiable, permanent, verifiable, and enforceable. Offset credits represent real emission reductions that occur outside of covered sectors. All compliance offset projects must be developed according to CARB-approved compliance offset protocols. CARB has adopted the following compliance offset protocols: livestock projects, mine methane capture projects, ozone-depleting substance projects, rice cultivation projects, U.S. forest projects, and urban forest projects. The ARB offset credits issuance timeline is depicted here. First, the offset project operator, or OPO, registers in CITSS, which is necessary in order to possess offset credits. Next, the OPO lists the project on an approved offset project registry. To do so, they submit basic project information required by the regulation and relevant compliance offset protocol. The OPO must then monitor project-specific data as required by the Compliance Offset Protocol for the duration of a reporting period. The OPO then develops and submits an Offset Project Data Report, which provides detailed project information as required by the Offset Protocol. An approved third-party verification body performs a detailed review and assessment of the Offset Project Data Report's accuracy and conformance with the protocol requirements. After verification, the OPO submits the project to the Offset Project Registry for Registry Offset Credit issuance. The Offset Project Registry reviews the Offset Project Data Report and the verification to ensure accuracy and conformance with protocol requirements before issuing the registry offset credits. The OPO then submits the project to CARB for ARB offset credits. CARB reviews the Offset Project Data Report and the verification to ensure accuracy and conformance with protocol requirements, and then issues ARB offset credits. Compliance offset protocols require the OPO to monitor and report for every year. Verification is required to be issued credits, but the OPO may verify multiple reporting periods together to reduce costs. CARB retains all decision-making authority to issue compliance offsets, and nothing related to policy or oversight of the program is delegated to the OPRs. Entities may use offset credits to meet up to 8% of their covered emissions for 2013 to 2020. Per AB 398, the offset usage limit will decrease to 4% for 2021 to 2025 emissions, and then increase to 6% for 2026 to 2030 emissions. Starting with 2021 emissions, no more than one-half of the quantitative offset usage limit may be sourced from projects that do not provide direct environmental benefits in California. There are 3 approved offset project registries: the Climate Action Reserve, American Carbon Registry, and Verra. See these registry websites for information on listed compliance offset projects. Note that the registries may also evaluate projects and propose offset protocols in the voluntary market. These activities are separate and distinct from CARB's compliance offset program.
CARB releases a detailed report that includes a list of all offset projects that have been issued ARB offset credits. This table is updated at 12 noon Pacific Time on the 2nd and 4th business Wednesdays of every month. Information on the vintages and quantities of offset credits issued can be found by selecting the ARB Offset Credit Issuance worksheet within the Excel file. Other worksheets within the Excel file explain the file's contents and highlight recent updates. The main table includes over 25 columns providing a wealth of information about each issuance and links to project documentation.
As mentioned earlier, CARB takes compliance with the requirements of the Cap-and-Trade program very seriously. CARB posts a compliance report each year reflecting the annual or multi-year emissions for each covered entity and the types and quantities of compliance instruments surrendered by each entity for compliance. All entities that were required to surrender compliance instruments for the second compliance period met their obligations. The summary report shows the breakdown of compliance instruments surrendered by each entity with the compliance obligation. The report includes details on allowance totals by vintage and offset credits by project ID and quantity. We often get the question, what can you do with a compliance report? First, you can track an entity's obligation back to its emissions. There is an ARB GHG ID assigned to every covered facility or source, which can be used to calculate the total covered emissions for an entity based on MRR's annual data reports. An entity may have one or multiple facilities registered to it. The total obligation is assessed at the registered entity level. Second, for most entities, the total emissions generated during a compliance period will equate to the total compliance instruments surrendered. However, changes to facility ownership, deferred emissions, bankruptcy, or non-compliance may result in a difference between the verified aggregated entity level emissions, an entity's total calculated obligation, and the total instruments surrendered. Finally, CARB continues to enforce rules to protect the integrity of the carbon market. Additional details on cases settled in lieu of litigation and those resolved by civil or criminal litigation are available on CARB's Enforcement Settlement webpage. The compliance summary reports available for each compliance event provide a detailed breakdown by entity on the number of compliance instruments and type used for compliance surrender. This information is useful as it can provide information on market interest for allowances and offset credits. Entities are currently able to meet up to 8% of their total compliance obligation using offset credits. For compliance period 1, entities surrendered 12,773,097 offset credits, which calculates to 4.39% of the total compliance instruments surrendered. For compliance period 2, entities surrendered a total of 62,717,868 offset credits, which calculates to 6.36% of the total compliance instruments surrendered. For compliance period 1 and compliance period 2, entities used a total of 75,490,965 offset credits, a small fraction compared to the 1,197,132,330 allowances surrendered by entities for compliance. This allowance total does not include those allowances used to meet the compliance obligation for the California Independent System Operator or CITSS Energy Imbalance Market or EIM outstanding emissions to EIM first purchasers. This accounts for an additional 1,191,506 allowances that CARB retired. For additional information on the California's Jurisdiction Retirement Account, refer to Video Module 1 or Slide 10 that provides a detailed explanation of each jurisdiction or entity account and the aggregated balances as reflected in the Compliance Instrument Report. It is important to note that once issued by CARB, offset credits may be used for compliance with the Cap-and-Trade program. However, they are not subtracted from the state inventory. For further information, refer to the California GHG Emission Inventory webpage on the next slide. The Cap-and-Trade program homepage was updated July 2019 to improve user interface and navigation. The new Cap-and-Trade program data webpage provides links to all data reports published by the program, as well as links to data from related programs. The overview of public data is a 4-page document describing the program's publicly available information. The California GHG Emissions Inventory, Mandatory Greenhouse Gas Emissions Reporting, and California Climate Investments links provide access to program pages with data related to the Cap-and-Trade program. This slide also provides links to the 4 video modules shown in this presentation. If there are any questions regarding this presentation material, you can call the Cap-and-Trade hotline 916-322-2037 or email CITSS registrar@arb.ca.gov. Thank you for watching this Cap-and-Trade program presentation. We hope that this presentation has been helpful in explaining the types of data that CARB publishes related to the program, where this information can be found, and how it can be used to better understand the linked California and Quebec carbon market.